We have Minggao Shen, who's the head of China research at Citigroup, and he joins us this morning on the program. And as you predicted, we had inflation coming in at 6.5%. What did you see?
Well, actually, this is in line with our expectation. We expect 6.5% for July, partly because of the rising cocoa price. And at the same time, I think the non-food CPI actually softened a bit. This shows some impact of monetary tightening. So I think we are comfortable to expect that CPI in China actually is peaked.
Okay, we've seen the peak. Okay, so for next month, do you have any predictions as to what we'll see for CPI?
We don't have the official number yet, but it will be below 6.5%.
All right.
Maybe still above 6, but there is a chance that it will go down to below 6% in probably September.
Yeah, especially as we have oil prices now below $80 a barrel. What about policy response? What do you expect the Chinese government to do, given the sell-off that we're seeing in the markets?
Well, I think first, policy side, the PBOC may hold off further tightening. For example, they already suspended the triple R hike in July, and there will be no red hike this month as expected. And some possible, it might be some selective easing is also possible down the road.
Yeah, but we've been talking about that. Maybe a release of triple Rs or even an interest rate cut might be on the cards for China. What are the possibilities?
Well, not there yet.
Yeah.
Right? I think unless the U.S. economy slides down further, unless, like a European debt crisis, develops to the wrong side, then I think, at the moment, policy reversal in China is still unlikely. As I said, the selective easing is possible. For example, they suspend the rate hikes first, and they can, inject a bit more liquidity in the open market operation side, and they can even cut triple R for smaller banks.
Yeah.
Supposedly, those smaller banks can lend more to small, medium-sized firms.
All right. Well, let's talk about the headwinds right now for the U.S. economy. We're seeing a slowdown, of course, no longer AAA rated. Then over in Europe, there's a sovereign debt crisis. What does that mean for Chinese economic growth, which a lot of people are now counting on to basically boost global growth?
Well, I think China's growth will have to slow a bit, which I think is good because that will cap China's CPI inflation. And that gives the government a bit more room to change its policy.
Okay, when you say slowing growth, I mean, how slow? We don't want it too slow.
Yeah, that's the key point. If there is a no recession in the U.S., in Europe, and the economy slows, it's good news for China. But the real risk is whether there will be a recession or double dip in the developed world.
Okay.
And in that case, then I think the Chinese economy will also have to enter into a low area of growth.
We're still waiting for basically urban investment and industrial production, retail sales. So why did we bring forward the inflation numbers? Was that significant at all, that release happening half an hour earlier today?
Well, I think it's not a big surprise, at least, right? So, and the recent development will confirm, again, the peak of inflation. Is falling commodity prices, slowing global economy, and possibly, there are other, like weakening demand, right? So these are all pointing to a lower CPI in the second half. Okay,
so what does this mean? Should you buy in right now and try to get some bargains?
I think the market is experiencing a last leg down, pricing in new uncertainties in Europe and the U.S. downgrading and probably U.S. slowdown. So, but on the China side, I think policy reactions could be another way to look at the buying opportunities. Overall, I think, yes, when the market falls further, it should hit the bottom, sooner. And, we should be
well, any recommendations in terms of sectors? Where should investors be looking?
I think when the uncertainties are still enormous at the moment, we want to be a bit more defensive. For example, we are looking at a counter-U.S. cycle plays like telecoms, consumer staples, utility names, and even airlines. So these are the possible plays that can do well when the U.S. economy or the U.S. market stays weak.
That's interesting. Airlines, which might benefit from the oil price now trading below $80. Okay,
joining me in Susan, Peter Lewis, MF Global Hong Kong CEO and head of Asian equities there as well as Citigroup, and Minggao Shen. That's still going to be joined by. I think that we're going to have a look
That's
at...
right.
Are you going to ask the first question, and who are you going to put it to?
Yeah, I think we're going to put it to both, because we were just talking about markets separately. Minggao talking about China markets, and Peter talking about all across Asia. And you said we still have a little bit more to go in terms of the leg down. What do you think, Minggao? Is he right?
Yeah, I think current risk is really about the recession in the U.S. or possibly Europe. And if you're looking at China's banking sector, its valuation is already priced in some kind of double dip, right? So the market is kind of preparing for that. So in my view, it is overreacting.
What do you think, double dip? You guys talked about that.
Yeah,
right?
you were saying that we have some way to go. We couldn't quite... I mean, if you knew exactly how long it was going to last, well, you wouldn't be sitting here. You'd be out making some money.
What are you saying? He doesn't make money? Is that what you're
insinuating? No, I'm saying that
insinuating?
you'd have a definite bet, and you'd definitely
I
know.
think you should take that sitting down, Peter. Anyways, I'm curious. What's your view? Double dip still?
I think there is a potential for a double dip recession, yes. But I think what we're going to see is markets like China are going to benefit from these declines in commodity prices. So I think what you will start to see is investors start to discriminate a little bit more between the various asset classes and between the various markets. And some markets like China, I think it's very undervalued at the moment. And if you look at, say, Warren Buffett's favourite valuation, which is market cap to GDP, at the peak of the market in 2007, it was 140%. It's now about 45%.
What do you think about Warren Buffett? That was really interesting, that he basically poured in the second quarter during the peak of basically the S&P since 2008.
You got a question then, because we had Barack Obama quoting him saying that he'd quadruple
A rated the U.S.
US. So, okay, you can't be right all the time, can you?
Well, I think the thing with the S&P downgrade is that it's inconceivable that America couldn't pay its debts. This is the world's richest economy. It prints its own money. The problem is there was a feeling that they might choose not to repay their debts, and that's really been part of the psychology of this market decline. It's the political dysfunction that's going on behind it all.
Minggao, I mean, what do you make of this? And, what do you make of it when it comes to China and the Chinese reaction, of course, to the political difficulties that the lawmakers had there on Capitol Hill?
Right. Well, I think China has more policy options or policy flexibilities. Right? It's different from the U.S. When their policy options are getting less. So, for example, I think China can move one step forward. In my view, they can monetize the service sector, providing investment opportunities, providing more supply so that more consumption. And if the government can monetize or privatize the service sector a bit, then the government can also raise more money to deal with local government debt problem. Right? And the Chinese structure and the Chinese future growth will be more sustainable. I think if there are any progress is making towards that direction, it will be supportive, positive to the market.
Are any persons here on the panel surprised by this reaction to the S&P downgrade? Because again and again, before this was actually announced on Friday evening in the U.S., Saturday morning here, people were just like, oh, yeah, if it happens, it's already priced in. Yeah. It's not that big of a deal. But then, look at these markets. It looks like the end of the world, some would say.
Well, the policymakers can do things about liquidity, they can do things about collateral requirements against US Treasury bonds. What they can't do anything about is investor confidence and how investors are going to react to particular...
And this is what we were talking about before, Minggao, which is the danger of people talking themselves into recession. Carry on, sorry, Peter.
Yeah, and I think, this is exactly what we've seen here. And part of the problem is that what we've learnt over the weekend is that the risk-free assets, which everyone uses in every type of pricing model for every sort of financial instrument, there's an assumption about a risk-free rate, which has always been US Treasury bonds. And what we learnt over the weekend is that US debt is as risk-free as Belgium's debt.
Yeah, I mean, Minggao, will you be also talking the world into a recession, or are you going to be giving us an optimist point of view?
Right. Well, I think the worry is not for the current downgrading, it's the worry about further downgrading. And that makes the U.S. assets even more riskier. So this is a worry. And if that happens, it will mean physical construction in the U.S. because the funding cost is rising. Right? So I think that is a worry. But for China, that actually is also good news because it will force the Chinese government to do further reform to reduce FX reserves. right?
Well,
When China finds no risk-free assets in the world, what can China do?
But, okay, hasn't China, they have $3 trillion in currency reserves, they've been buying U.S. treasuries because they need to keep the currency down. They need to buy dollar assets and make sure that the yuan doesn't strengthen too much. Are they going to diversify at this point with this downgrade? I'm not so sure.
There's nowhere to hide. That's the problem, right? So to resolve the problem is actually not to diversify as a secondary, second best choice, but the first best choice, in my view, is to reduce FX reserves as much as possible. So this means structure adjustment, structure changes down the road.
Which means what? Not being an export-led economy?
Yeah.
They've been working on that. That takes more than just 1 year, 3 months, 6 months.
It takes 5 years.
Oh, does it? Is that your estimate?
It's a 5-year
yes,
plan.
Professor Rishaad.
5-year plan says it's going to work.
You have to question, why does China need $3.2 trillion of foreign currency reserves? That's far, far more than its requirements.
Why do you think they need $3.2
well,
trillion?
in many ways it's madness, because if you think what they're doing, they are in effect, they're one of the world's biggest recipients of foreign direct investment. So they're in effect taking that money and then re-lending it back to the world's largest economy at rock-bottom interest rates when its own population has a per capita income far, far below the US. So it's not a very constructive way of using those reserves. So I think where there will have to be a change is the Chinese government itself questioning, do we need to accumulate so many US dollar assets?
If they don't carry on doing it, the US will be in serious problems, and then we will see a default, and then we will see a currency which is going to be worth nothing, which will mean their reserves will be worth nothing.
And also what will happen is the RMB will appreciate as well. But again, maybe this is going to be a precursor towards an opening up of the capital account, maybe quicker than
That's a safe haven, isn't it?
Yeah.
RMB right now?
Yeah, I think the key here is how fast the Chinese growth needs to be. That's the key. I mean, if the government is able or is willing to lower GDP growth intentionally, then we don't need that much exports. We don't need that much FX reserve.
Right.
So this is fundamentally rooted in the growth model.
Okay.
So this will have to be changed.
Okay, well, take a listen to Wilbur Ross, the billionaire investor that I spoke to today. Not only is he optimistic that we'll find a bottom in the markets, but he says there are places to hide. And take a listen to where he says they are.
If you look out over the next several years, there's plenty that's attractive, and even more particularly, plenty that's attractive in the emerging markets. Some of the emerging markets had been struggling even earlier this year. For us, the main emerging markets have been China, #1, and to a somewhat lesser degree, India. We also are reasonably active in Japan, although obviously that's a very developed market, not an emerging market.
Yeah, and I guess he also mentioned Ireland as well. That he's interested. Yeah, he did. Maybe not in that soundbite, but okay. So in the emerging space, he's talking about China and India. That's a place to run for safety right now, considering the sell-off we're seeing across the world.
I would agree with him.
Yeah.
I think emerging markets are going to be a safe haven bet. I mean, if you look at the structural changes that have gone on in the global economy, emerging markets have only 17% of all the global sovereign debt. They are the reverse, if you like, of all the deficits that occur in Western economies.
It's got to get Minggau's view on that as well.
Well, I think when the U.S. Treasury becoming risky assets, then investors will have to balance return and risks. And high growth, potential is one place to look at. And I think China's GDP growth can still grow, at around 8 to 9% for a few more years.
Yeah. That sounds healthy.
Yeah.
Yeah.
And just thank you guys. Thank you very much indeed. Minggao Shen there from Citigroup, and we've got Peter Lewis from MF Global as well. And Ireland perhaps is an emerging market.
Now that it is, yes, that's right.
I'm not saying anymore. I'll get into trouble with a friend of mine.